The growth outlook is optimistic, so it's not as if we are falling off the cliff in terms of growth, and MPC now needs to act hurriedly in terms of restoring growth, or there is a serious action required, which is why I don't feel that we have a series of big amount of rate cuts in the pipeline, but it does feel like that maybe another 25 basis point rate cut during the course of next 6 to 9 months, particularly if the inflation data behaves the way they have forecasted it to be, should not be out of question.
We believed it was erring on the cautious side and holding as our basic call in terms of the policy rates. So 25 basis point rate cut has come on the back of downside surprises of inflation, including the forecast presented by RBI, which surprised you as much as by 80 basis points if I look at the upper bound of the H120 fiscal 20, which is 3.4, and it's a cut of almost 80 basis points from the earlier inflation trajectory. So that was the first. The second, in my opinion, was the RBI drawing comfort from a fair amount of revision, downside revision in household expectations of inflation as well as business expectations on inflation. To me, that has been, I think, also one of the guiding factors for the central bank to get comfortable with the rate cut. The third, I think they have unambiguously stated that, it is perhaps an appropriate time to support private investment activity as well as buttress private consumption.
Expectation was that in this policy you'll have the stance change, and probably going forward, if the numbers further support, there could have been cut. But then I think as governor has gone on record saying that the mandate is on the headline inflation, and headline inflation is with big figure 2. If that be the case, then of course, despite core inflation being closer to 6%, I think it was thought that we should go by the headline inflation number, and therefore look at the growth part and move from price stability to growth.